So Barry, we get asked all the time, what's the best company for high cash value life? And we vet companies. We talk about that a lot. We have tons of articles on the website about it. But today I know we want to talk a little more about why a company might be the best for somebody, what kind of things should people look for, and so let's dive into the example.
Yeah, and Steve's an attorney, so I'm going to give the attorney answer, which is it depends, right? Your goals are important. We're always going to look at your goals, but today we're going to look at the top two companies, Penn Mutual, Lafayette Life, why you might choose one over the other. I love this analogy. Let's say you're going to take a road trip from California to Las Vegas. You can get there in a Cadillac, you can get there in a Corvette. What we're looking at today, the Penn Mutual illustration is more like the Cadillac. Better gas mileage, maybe smoother ride. Lafayette is like the Corvette. You're going to get there quicker, higher cash value in the early years. So it's a fun analogy to think about. What we have here on the board to start, this is Penn Mutual, and we're showing a female at the age of 35 starting with $20,000 a year going into the policy. And by the way, she's not locking into $20,000 for the rest of her life. The minimum premium on this policy is only about $3,500 a year. So in a year, she could reduce down.
Okay.
Where we want to focus is this total cash value column. And in year one, it's $16,897, which is just over 80% of her premium going into cash value.
Based on the 20?
Based on the 20.
Yep.
And every year we see this cash value continuing to get larger and larger. It's growing on a compound growth curve. $16,897 with a death benefit of $559. And this is a combination of both whole life insurance, term insurance, and it keeps growing as well. Yeah, that's right.
All right.
Well, in our second example, the Corvette example, with Lafayette Life, let's clear this out, bump over to Lafayette Life, and we're going to see here that the first year cash value is $18,641. So a lot of you might be thinking, well, Barry, why are we even looking at Penn Mutual at $16,000 compared to Lafayette? It's because over time, we will see Penn Mutual pull ahead of Lafayette. So if someone wants the highest cash value possible, in this case, it's going to be years 1 through 6, you go with Lafayette Life. But if you want higher cash value year 7 forward, then you go with Penn Mutual. So we'll look at that number. 10 years out, for example, we've got $239 with Lafayette Life. And we'll clear this out. Penn Mutual, $243. Right there, $243 with the cash value.
Yep.
Steve, if someone's looking to take early policy loans, they want to invest in crypto, they want to invest in a business, they want to buy real estate, they might say, hey, I want to go with Lafayette Life because I'm getting more cash and there's more available for me to use as a policy loan.
In those early years. Now, as an estate planning attorney, I kind of go over here. So did we compare those two numbers as well?
That's a great point.
Because this is huge. Early years, you get huge leverage for that death benefit.
Yeah,
which is
let's
great.
look at it. $559 in year 1 to $1.1 million in year 10. Lafayette, $371.
So it's a little bit lower. Yeah.
And how about year 10?
In year 10, you're at
$834.
So you do see a little bit less leverage on the death benefit side. So again, it's a question of goals.
Yeah. Yeah. If you're, again, wanting that highest cash value in the early years, you're not so much concerned about death benefit. Lafayette's an amazing company. But as Steve's pointing out, for estate planning, you get more death benefit with Penn Mutual. That year 10 number, it's actually about year 8 forward. You're going to get more cash with Penn Mutual. And it's a personal decision. We're not making the decision for you. We're going to show you the top companies in the industry You choose what's best for your goals. Then we start talking about long-term money, tax-free retirement income. And what's great about these, Penn Mutual, for example, we're only showing the 20,000 funded through the 20th year, and then starting year 21, dropping down to that 3,400 annual premium. Well, check this out. At the age of 61, premium outlay is zero. There's no more money going into the policy. But look at these cash values.
Yep, they continue to grow.
Continue to grow. 50, 60, 70, 80,000 a year in growth, Steve. No more premium going in.
Mm-hmm. Yeah. And what a great place to be as an older person. And a lot of times people that criticize the strategy, they don't think about this aspect. Being in that place at that age.
Yeah. I said yesterday to a client, because we're looking at policies for someone younger, and both the father and the son were on the call. And I made the joke, I said, to the father, don't we wish our parents would have done this for us 20, 30, 40 years ago? Because look at this money. If this female 35-year-old at the age of 70 wants to start taking out income, there's $1.57 million there. She only put in 416. Well, we teach her how to turn 1.56 million into about 2.2 million tax-free on a $416,000 premium payment.
Those are good numbers.
Good numbers. And look at the death benefit.
Right? Look at that death benefit. And it's good whether you're in a Corvette or a Cadillac.
That's right. Appreciate y'all joining us. As always, take a look at your own numbers, and we would love to work with you and show you why adding high cash value whole life to your portfolio will enhance your entire portfolio and your life.
Thanks for watching.